kind of wild, right? You decide, okay, I need life insurance. And you think it's just going to be like a quick in and out thing.
Yeah.
But have you ever actually thought about, like, what happens after you hit submit on that application?
Yeah.
There's a whole world going on behind the scenes. And today, we're going to pull back the curtain and see how it all works.
I love it.
So we've got this super interesting document you send over, Chapter 7, Life Insurance Underwriting and Policy Issue.pdf. And we're going to use that as our guide to really break this whole process down.
Sound good.
Think of this as like a backstage pass to the world of life insurance underwriting and how a policy actually gets issued.
Exactly. Yeah, we're going to kind of dissect the journey of a life insurance application from that very first piece of paperwork all the way to the point when the policy is issued.
Right.
And your document, it really gives us this fantastic, detailed look at all those critical steps in between. Our goal today is to pull out the really important nuggets, maybe clarify some of the jargon that can be a little confusing, and even uncover some of the maybe surprising logic behind how insurance companies evaluate risk, assess you, and decide whether they can even offer you coverage and at what price.
Right. Yeah.
By the end of this, you should feel really confident about what this whole process entails. So let's just jump right in. Let's start with the basics. What is underwriting in the context of life insurance?
Yeah. Okay. So underwriting, I feel like that's like this term that gets thrown around, but like, what's the core concept here?
At its heart, underwriting is the insurance company's process of assessing whether or not they can actually take on the risk of insuring your life. They're trying to figure out basically what are the odds.
Okay. And why do they need to do all this? Like, why can't they just insure everyone who applies?
That's a great question, and it really boils down to a concept called adverse selection.
Adverse selection. Okay.
It's actually a core reason why underwriting even exists. Think about it this way. Someone who, knows they have some serious health problems, they're going to be a lot more eager to get life insurance.
Oh, yeah, for sure.
Compared to, someone who feels perfectly healthy, right? So if insurance companies didn't have a way to assess those individual health risks, the pool of people they're insuring would be way skewed towards those with higher mortality risks. And ultimately what would happen is that would drive up the premiums for everyone, making insurance less affordable.
It wouldn't work. Yeah.
Exactly. So underwriting acts as a safeguard to make sure that the risk pool is balanced and keep those premiums reasonable. It's all about fairness for everyone who has a policy.
That makes a lot of sense. So it's like protecting the system in a way. So let's talk about when an application lands on their desk, who are all the people involved in this underwriting process? I feel like there are a bunch of different roles floating around.
Yeah, you're right. There are several key players in this whole thing. First, you have the field underwriter, and that's actually your insurance agent, the one you work with initially.
Okay, so they're kind of like the front line.
Exactly. They guide you through the process, gather the information. Then, of course, you have the applicant, the one filling out those forms.
Right, the person applying for the insurance.
Right, and then there's the proposed insured. This is the person whose life is actually being insured. And often, it's the same person as the applicant, but not always.
Okay, I see where this could get tricky.
You also have the policy owner, and they're the one who holds the rights to the policy. Again, that could be the applicant or someone else. And finally, back at the insurance company headquarters, you have the underwriter, the person with the big stamp.
Yeah, the one making the decisions.
They're the ones reviewing everything and deciding, yes, we can offer this policy, or no, and at what rate.
So that's like 5 different hats, potentially.
Yeah, exactly.
So maybe, just to illustrate, can we run through a quick scenario to keep all those roles straight?
Absolutely.
Yeah.
Let's say Sarah decides, I want to get a life insurance policy on myself. She meets with an agent, fills out the application. In this case, Sarah is the applicant. She's the proposed insured because it's on her life. And let's say she's also going to be the policy owner, the one managing it and paying the premiums. Makes sense, right?
Totally.
Now, let's say Sarah also wants to get a policy for her daughter, Emily, who's a teenager. In this case, Sarah is still the applicant. She'll probably be the policy owner and pay the premiums, but Emily is now the proposed insured.
Right, because it's on Emily's life.
Exactly. And their agent is the field underwriter for both of those applications, and then the underwriter back at the insurance company will evaluate the risk for both Sarah and Emily separately.
Makes sense. So it's like a web of relationships and roles.
It is, yeah. And it's important to understand who's who. So now, as the underwriter at the insurance company is starting to dig through an application, they have 2 really fundamental questions they need to answer.
Okay, the big 2. What are they?
First, they need to determine if what's called an insurable interest exists.
Insurable interest, okay?
And second, they need to figure out whether the proposed insured is actually insurable based on their risk profile.
Okay, makes sense. So let's start with the insurable interest. That sounds like more than just, like, caring about someone, right?
Yeah.
Like, what's the actual financial or legal angle here?
Yeah, it's not just about, liking someone a lot. Insurable interest really comes down to a financial or economic relationship where one person would actually suffer a genuine financial loss if the insured person were to die.
So it's like having skin in the game.
Exactly. You got to have a legitimate reason to want that person to stay alive from a monetary standpoint. You can't just like randomly insure a celebrity you admire.
Right, yeah. So in what relationships is this insurable interest, like, automatically recognized? I know our source lays out a few.
Yeah, there are some common sense ones that are usually presumed.
Mm-hmm.
You on your own life, that's an obvious one. Spouses with each other,
Mm-hmm.
parents on their children, children on their parents or grandparents.
Makes sense, yeah.
It also extends to business relationships, like a business on its key employees or executives, business partners on each other, and even creditors on debtors. Like if you owe someone money, they might have an insurable interest in you, but usually only up to the amount of the outstanding debt. What's important here is that just having, sentimental attachment, like just feeling love or affection, that's not enough. You can't insure your favorite barista just because they make a mean latte.
Right, yeah. Got to be that potential for financial loss. So when does this insurable interest need to exist? Does it have to be there throughout the entire life of the policy?
No, that's interesting. With life insurance, it only needs to be present at the very beginning when the policy is first bought,
Oh, okay.
at the time of application, basically. It doesn't necessarily have to still be there when the person eventually dies.
That's kind of fascinating.
It is, and it's what allows for things like policy assignments, where the ownership of the policy can change hands down the road.
Okay, so like if a business takes out a policy on a key employee and that employee leaves, they could potentially transfer the ownership of the policy. Okay, that makes sense. So how much insurable interest is enough? Like, are there limits on how much coverage you can get on someone else?
This gets a little fuzzy because, unlike property insurance, where the idea is you're only compensated for your actual loss, you can't really put a price tag on a human life, right?
Yeah, exactly. It's way more complex.
Generally, the amount of coverage has to be reasonable, justifiable based on the potential financial loss. So the insurer is going to look at things like income, debts, future needs, things like that.
Right. So like a stay-at-home parent versus a CEO, the coverage amounts might be vastly different.
Exactly. And of course, the policy owner has to be able to afford the premiums, and the insurer has to be willing to issue that much coverage. One interesting point is that an individual is considered to have an unlimited insurable interest in their own life.
Okay. Yeah, that makes sense.
There might be some practical limits, though, especially when you're talking about insuring children. Often, the amount of coverage they can get is tied to how much insurance the parents have on their own lives.
Oh, I see. That makes sense. So we've tackled insurable interest. Who needs it? Why it matters. Now let's move on to that second big question. Is the proposed insured insurable? Like, what are the boxes they're trying to check here?
This is where things get a little more nitty-gritty. The insurance company is now assessing the actual risk of insuring this particular person. And there are a bunch of characteristics that make a risk insurable, and our source outlines these really well. So the potential loss, which in this case is death, it should be accidental, meaning like not planned. It also needs to be measurable in financial terms. There needs to be some way to put a dollar amount on the loss.
Right, so not something like, oh, they might lose their job, but something more concrete.
Exactly. And the event itself, death, has to be clearly definable. There should be no chance for the policy owner to profit financially from the insured person dying, right?
Yeah, it's not about like gambling on someone's life.
Definitely not. And the insurer needs to be able to apply this concept called the law of large numbers. What that means is they need a big enough pool of similar risks to be able to predict losses statistically.
Oh, I see. Like, if they only insure a handful of people, it's way too unpredictable.
Right. They need that large sample size. Also, the potential financial hardship caused by the loss should be significant. This is kind of tied back to the insurable interest idea. And the event shouldn't be catastrophic for the insurer.
Okay, so like a massive pandemic or a war, that might be excluded.
Exactly. And finally, the event should be unpredictable, or fortuitous is the fancy word they use. It should happen by chance, not be something that's guaranteed to occur.
Yeah, so you can't insure someone who you know is, like, terminally ill and only has a few months to live.
Right. It defeats the purpose of insurance.
So essentially, the whole underwriting process is all about gathering a bunch of information and seeing if the applicant fits within these guidelines and the insurance company's risk appetite, right?
Precisely. It's like putting together a puzzle. And the first person to really start working on this puzzle is the insurance agent. Their role at this initial stage, it's often called field underwriting, and it's super important.
Okay, so the agent is kind of doing, like, a preliminary risk assessment from the get-go.
Exactly.
What are some of their key responsibilities in this phase?
So the agent is representing the insurer, and they have to act ethically and professionally. They're responsible for soliciting business properly, which means focusing on people who actually make sense for the insurer's products and risk profile. They shouldn't be trying to sell policies to people who are clearly not a good fit.
Right, not just trying to make a quick buck.
Absolutely. They also need to help the applicant complete the application accurately and thoroughly. All the questions need to be answered honestly and completely.
So, like, making sure there are no, like, blank spaces or missing signatures or anything like that.
Exactly. They need to get all the necessary signatures from the applicant, from the proposed insured if it's a different person, and of course their own signature as the producer.
Okay, so triple checking everything.
Yeah. And if there's an initial premium being paid with the application, the agent's responsible for collecting that and issuing the correct type of receipt, which we'll talk about more in a bit. It's really important that agents handle this stage carefully because even unintentional mistakes can lead to what are called errors and omissions. That's why a lot of agents have E&O insurance, which stands for errors and omissions insurance, to protect themselves financially if something goes wrong.
Oh, that's interesting. So it's like their own safety net.
It is, yeah. Now let's talk about the application itself. It sounds like this document is like the holy grail of the whole process.
It is, yeah. It's like the foundation. Why is it so critical for the underwriting department?
The life insurance application is the main tool that the underwriters use. It's their primary source of information for deciding, can we offer coverage, and what's the price tag?
Makes sense.
What's the premium? Now, our source material breaks it down into 3 key parts. Let's do a quick overview of what each part covers.
Sounds good. Yeah, let's walk to it.
So part 1 is all about general applicant information. This is where they gather the basic stuff, names, ages, addresses, contact info for both the applicant and the proposed insured. It also digs into the specifics of the policy, like what kind of coverage are they asking for, how much, and who's the beneficiary, the person who's going to get the money if the insured person passes away.
Okay, so like the nuts and bolts of the policy.
Exactly. Interestingly, I also often asks about lifestyle stuff, like, do you smoke? Do you have any dangerous hobbies, like scuba diving or flying planes?
Oh, right, because those things could affect your risk. Okay, so that sets the scene. What about part 2?
Part 2 is where it gets a little more personal. This is the medical and health history section.
The health checkup.
Exactly. They're going to ask a lot of questions about your current health, any past illnesses, surgeries, hospitalizations, and even about the health history of your immediate family.
Oh, wow. So they're looking at potential genetic predispositions, too.
They are, yeah. And the answers in this section, they're often what triggers the need for a medical exam or more medical tests, which, as we mentioned before, are usually covered by the insurance company.
Okay, makes sense. So they're gathering as much data as possible to assess the risk. Now, what about part 3, the agent's report? What kind of intel does the agent provide here?
This is where the agent adds their own 2 cents, so to speak. Since they're the one who's met with the applicant face-to-face, they can share their observations and insights.
So it's like their subjective take on the applicant.
In a way, yeah. They might comment on the applicant's financial situation based on what they observed.
Okay.
How they present themselves, their overall character, the stated reason for buying the insurance, how long they've known the applicant. And this is also where they disclose whether this new policy is meant to replace an existing one, which can sometimes trigger additional regulations.
Okay, so like if you're switching policies, they want to make sure it's being done for the right reasons.
Exactly. It's about consumer protection. So now, imagine you're the one filling out this application.
Okay, I'm putting my imaginary insurance hat on.
Accuracy is obviously super important, right?
Yeah, I'd imagine so.
What could happen if you make mistakes or leave things out?
Well, I guess it could delay the whole process.
It definitely will. The insurance company is going to have to send it back to the agent to get that missing info. But there's more to it than just delays. It's important to understand this legal distinction between representations and warranties in insurance. Generally, the statements you make on the application are considered representations.
Okay, and what's the key difference between those two terms?
So a representation is something you believe to be true to the best of your knowledge. It doesn't have to be like perfectly accurate in every tiny detail.
Okay.
A warranty, on the other hand, is a guarantee that something is 100% absolutely literally true. And most states have laws that specifically say statements on insurance apps are treated as representations.
Okay, so that gives you a little wiggle room?
It does, but here's the catch. If you make what's called a material misrepresentation, like you straight up lie about something important that would have affected whether the insurer would even offer you a policy or how much they'd charge you, then they might have grounds to void the policy later.
Oh, so you can't just, like, fib about your smoking habits or your health history and hope for the best.
Exactly.
Yeah.
And to be considered fraudulent, there usually has to be evidence that you intentionally lied with the intent to deceive.
Okay, so it's all about being honest and upfront. No shortcuts. Now, who needs to sign this application to make it official?
You'll usually need the signatures of the applicant, the person applying, and the insurance producer, which is the agent.
Okay, so that's the standard too.
Right. Now, if the policy owner is different from the proposed insured, like in our Sarah and Emily example, you'd need 3 signatures. Sarah as the applicant and owner, Emily as the proposed insured, and then the agent.
Okay, I see.
And it's interesting, the beneficiary, the one who's going to receive the money, they don't usually sign the application. And one more little detail, while minors, kids can't typically sign contracts, most states have rules that let someone over a certain age, often around 15, sign for themselves on life insurance applications.
Okay, that makes sense. You want to give them some agency. So what happens if you, realize you made a mistake on the application after you've already turned it in? Can you fix it?
Yes, you can, but there's a proper way to do it. If you catch the mistake while you're still with the agent, they can make the correction, but then you have to initial it to show you agree with the change.
So like a paper trail of accountability.
Exactly. And the agent should never, ever change anything on their own without your consent.
Right, that's super important.
Now, if the insurance company finds a mistake after they've already issued the policy, they might have the right to cancel it. But this is usually only within a certain time frame called the contestable period, which is typically the first 2 years the policy is active.
Okay, so like a grace period where they can still double check things?
Exactly. And after that period, there's this thing called the incontestable clause, which basically prevents them from denying a claim based on a mistake in the application unless it was blatant fraud.
Okay, so there's some protection for the policyholder too.
Definitely. And it's important to remember, once the policy is issued, the application becomes part of the legal contract.
Oh, wow, so it's not just like a throwaway document.
Nope, it's serious business. Okay, let's shift gears a bit and talk about money, the fun part.
Always a fun topic.
Often you'll hear about the option of paying the first premium right when you submit your application.
Okay.
So what do you think? What's the benefit of doing that?
I would imagine it might speed up the whole process.
It can, yeah. And for the agent, it helps solidify the sale and maybe even get their commission faster. But more importantly, for the person applying, paying up front can sometimes get you immediate coverage, although it might be temporary and conditional depending on the kind of receipt they give you.
Okay, so instant gratification, potentially.
Yeah, kinda. It shows you're committed and it can help things move along faster.
So what happens if you decide, no, I don't want to pay the initial premium with the application?
That's totally fine. The agent will still submit the application, but even if it's approved and they issue the policy, the coverage won't actually start until you pay that first premium.
Okay, so it's like a waiting game.
It is, yeah. It's like a trial application.
Hmm.
They've reviewed you, but the deal's not sealed until the money's on the table.
Makes sense. It's a contract, after all. So if you do pay that initial premium, they give you a receipt, right? And our source talks about different kinds of receipts.
Yeah.
Conditional and binding receipts.
Yeah, those receipts are more important than they look.
Okay.
They're your proof of payment, but they also determine when your coverage might actually start. So a conditional receipt, which is the most common one you'll see with life insurance, it basically says your coverage will start from either the date on the receipt or the date of your medical exam if you need one. But, and this is a big but only if the insurance company ultimately decides that you are insurable on that date based on their rules.
That's like a maybe coverage.
It is, yeah. It's conditional on you meeting their criteria. If they do all their checks and decide, nope, this person wasn't insurable, then the coverage never actually started, and they'll refund your initial premium.
Okay, so it's a gamble, in a way.
It can be, yeah. And there are even variations within conditional receipts. Some are insurability type, meaning if you can prove you are insurable, coverage could start even before they officially issue the policy.
Oh, interesting.
Others have approval language, which means coverage only kicks in after they've reviewed and approved everything.
Okay, so the wording on that receipt is super important. Can you give us an example of how this conditional receipt thing might play out in real life?
Absolutely. Let's say you apply for life insurance on, let's say, June 1st,
Hmm.
and you pay your first premium, and they give you a conditional receipt. Now, they require you to get a medical exam, which you do on June 5th. If you have an insurability type conditional receipt, and they decide based on all the info they have as of June 5th that you are insurable, then your coverage could technically be in force from June 5th onward.
Okay, even though the actual policy hasn't been issued yet.
Exactly. Now, if something were to happen to you, sadly, between June 5th and when they finally issue the policy, the insurance company would still finish all their underwriting checks.
Okay.
And if they determine that, yeah, you met their rules as of June 5th, they'd pay out the death benefit. But if they decide you were insurable, then they deny the claim, but they'd refund your premium.
Okay, so it's like retroactive coverage, almost.
Yeah, kind of. Now let's talk about binding receipts.
Okay, this sounds more straightforward.
It does, right? This type is less common in life and health insurance, but when it is used, coverage usually starts immediately when you pay that first premium. And it stays in effect until they either issue the policy or officially reject your application. So even if they later discover something that would normally make you uninsurable, if you pass away during that binding period, they'd still have to pay the claim.
Oh, wow, so it's like a guarantee.
It is, yeah. And that's why insurers are a little more cautious about using binding receipts. They're taking on more risk. So you'll often only see them with very experienced agents, and there might be limits on how much they'll pay out during that binding period.
Makes sense. They're not going to just hand out guarantees to everyone.
Exactly. You're more likely to see binding receipts in things like car insurance or homeowners insurance, where the risks are a little more easily defined.
Okay, that makes sense. So we've covered the application, the premiums, the receipts. What other sources of info do underwriters use to really get a full picture of the risk?
Yeah, so after the application and maybe that initial premium, there's often a lot more digging that goes on, especially if the application raises some flags like, health issues, risky hobbies, or if it's for a really large amount of coverage.
Okay, so they're doing their due diligence.
They are, yeah. They might request a medical report based on what you put in the application or how much coverage you're asking for. Interestingly, these reports aren't always done by a doctor. They could be done by a paramedic or a nurse, depending on the situation.
Oh, that's interesting.
They might also ask for an attending physician statement, or APS. This is basically a request to your doctor for more details about specific medical conditions that came up in the application or during the medical exam.
Okay, so they're going straight to the source.
Yeah, but they need your permission to do this because it's obviously confidential medical information.
Makes sense.
You have to sign a form authorizing your doctor to release that info.
Right, protecting your privacy. Now, I've heard about this thing called the Medical Information Bureau, or MIB. What is that, and how does it factor into all of this?
The MIB is a really interesting organization. It's essentially a massive database of health information that's shared among its member insurance companies, and there are over 700 of them.
Wow, okay, so it's like a big network.
It is, yeah. Basically, when you apply for life or health insurance with a member company and they discover you have a certain medical condition, they report that to the MIB, but in a coded way. So it doesn't have your specific diagnosis, but it flags that there's something going on.
Okay.
Now, if you later apply for insurance with a different member company, that company can check the MIB and see if there's a record on you.
Oh, I see. So it's like a way to cross-reference information and make sure you're being consistent.
Exactly. It helps them catch inconsistencies or things you might have forgotten to mention. It can also flag lifestyle habits like drug or alcohol use, things like that.
So it's kind of like a background check, almost.
It is, in a way. And the main goal is to help keep insurance affordable for everyone. By preventing fraud and identifying higher risk applicants early on, they can keep costs down.
Right, because if people are trying to, hide things or be dishonest, it ultimately hurts everyone else.
Exactly. And it's worth noting that you have the right to get a copy of your MIB report from your doctor.
Okay, good to know. What other types of information might they dig up during underwriting?
They might use special questionnaires to get more details about specific risks. Like if you're a pilot, they might have a whole questionnaire just about your flying history.
Oh, right, because that's a high-risk activity.
Exactly. Same thing if you travel to certain countries a lot, if you're in the military, or if you have a dangerous hobby like skydiving.
Okay, so they're tailoring the questions to the specific risk.
They are, yeah. For larger policies, they often do what are called inspection reports or sometimes consumer reports.
Okay, what are those?
This is like a deeper dive into your background. They're looking at your character, your reputation, your lifestyle, how you handle money, any unusual hazards you might be exposed to. They might even interview your neighbors or coworkers.
Wow, that's pretty intense.
It is, yeah. But you have rights here under the Fair Credit Reporting Act, or FCRA.
Okay, what does that protect?
It basically says they have to tell you if they're ordering one of these reports, and they have to give you a copy of it if you ask.
Okay, so you're not completely in the dark.
Right. They also sometimes pull your credit report to see how you manage your finances.
Yeah.
If you have bad credit, it might make them think you're more likely to let your policy lapse, which would cost them money.
So they're looking for responsible people.
They are, yeah. Now, speaking of the FCRA, we've mentioned it a few times.
Right, the Fair Credit Reporting Act.
This is a federal law that protects your rights when it comes to these consumer reports, both credit reports and those investigative reports we talked about.
Okay, so it's all about making sure the information is accurate and used fairly.
Exactly. It also gives you the right to dispute anything that's wrong in your report.
Okay, that's good to know. You mentioned the USA Patriot Act earlier, too. What's the connection there?
So the USA Patriot Act, it was passed after 9/11, and it's all about preventing money laundering.
Okay.
And because life insurance policies, especially the ones that build cash value, they can potentially be used to like hide money or move it around illegally, this law requires insurance companies to have strict anti-money laundering programs.
Oh, I see. So they're making sure life insurance isn't being used for shady stuff.
Exactly. They have to have procedures in place to detect and report any suspicious activity.
So it's like a safeguard for the whole financial system.
Uh,
Okay, so after all this investigation, how do underwriters actually categorize the risk? Does everyone who gets approved pay the same premium?
Not at all. Once they've looked at everything, they'll put you into a risk category. And some people, unfortunately, are deemed uninsurable and they get declined. But most people fall into a few categories. The best one is preferred risk. This is for the healthy folks, the non-smokers, the people living their best lives.
Okay.
They get the lowest premiums because they're statistically less likely to die young.
Makes sense.
Then there's standard risk, which is like the average Joe. You're not super healthy, but you're not high risk either. You pay the standard rate.
Okay, the middle ground.
Right. Then there's substandard risk. This is where things get a little pricier.
Okay.
These folks have a higher risk, maybe because of health issues, their job, or their lifestyle. They might still get coverage, but they'll pay a higher premium, what's called a rated up premium.
Okay, so they're paying a little extra to offset the higher risk.
Exactly. And in some cases, if the risk is really high, they might get declined altogether.
Right. It's all about balancing the books for the insurance company.
It is, yeah. And it's important to know that they can't discriminate unfairly.
Okay, what does that mean?
Like, they can't deny you coverage based on your race, your religion, your sexual orientation, where you live, stuff like that.
Right, so it has to be based on legitimate risk factors.
Exactly. Okay, so the underwriters made their decision. You're approved. What happens next? How do you actually get that policy in your hands?
Yeah, the moment of truth.
It's time for policy issue and delivery. They'll create the official policy documents, and they have to get them to you. Are really key.